Do you ever feel like we're playing a game with the market, with the ups and downs, with the tariffs, with them being on, with them being off? They've been wreaking havoc in the S&P 500 and all of the indexes, and even the Nasdaq is almost into the correction zone, which is a 10% decline over its all-time high. Now, in today's video, I want to note something that is on MSN, and it talks about the market rally that we could see with the S&P 500 based on, and I seen an article not even an hour ago that says the tariffs might be on pause. So we've seen a multitude of days when the market has been down and it has dropped significantly. Even the crypto market seeing a much harder and really harsher drop. And overall, if the tariffs only last a day or two, it's going to be kind of crazy, because if you think about longs and shorts, some people have made multi-millions, if not billions of dollars from just the news that is coming up. Now, when investors notice unusual trade activity in a stock, they pay close attention to the company itself. When you think of dividends, there has to be some reason behind the activity that we're seeing to get behind whatever fundamental factors we are seeing in the market. And that's exactly what we're seeing. Not the tailwind of a company, and not just one, but very unusual trading, not in stocks, not in a single company, but in the S&P 500 itself. Now, this time up to $1.8 million worth of call options are spotted as a buy in the S&P 500. So when you think of some of the hedge funds, when you think of the large fund managers, they have almost $2 million worth of call options out there. Me personally, I started investing in call options a while ago. They have been doing incredibly well, even though the underlying asset has really come down a little bit. The call options are producing a lot of dividends overall. Now, last week, and here's why 1.8 million in call options means there's a lot more than really the same amount of a pure stock. They are investing in that S&P 500, specifically the SPY. Now, if we know recent events, the SPY and the VOO, Warren Buffett actually sold out entirely. Right around $42-43 million was just liquidated out of Berkshire Hathaway, meaning he is completely out of those ETFs itself. Now, options carry two fundamental differences if you're not familiar with them. Leverage, meaning you can borrow and you can honestly bet a lot more money than you have, is really the way to really leverage it. And of course, timing, meaning if the option buyer doesn't get the direction correctly and the timing that a stock is going to move, contracts can expire, meaning it is going to be a lot of money. So again, when we start looking at a larger investment houses, and when you start looking at companies, when you look at 1.8 million could bet up to tenfold, meaning 1.8 million all of a sudden is a lot more money, as in the amount of possibly 18 million, or depending exactly how many times they go through and how many times this options are really sold, which is kind of crazy. Now, the retail level is really confident in the S&P 500. We've seen it over the last 2 years with an incredible amount of growth. Then the next logical question comes, and really relying on that S&P 500 to make a new all-time high. So what we might be seeing is some people actually, digesting the news, knowing that the tariffs are going to be bad, maybe overemphasizing exactly how bad those tariffs are going to be. But when we also look at other asset classes and related to stocks, it seems like the market itself, a lot of people are pulling money out of it in general. Now, this also shows there's a big risk appetite. There's been a lot of surveys, a lot of talk about the risk of younger investors, that if you're in your 20s and 30s, a lot of people have a huge risk appetite, meaning they will take on a lot more risk. And we see that again, not only with the S&P 500, but leveraging positions and also the crypto market. When we start looking at some of the world's biggest and best investors, very successful by employing a global macro strategy and seeing what markets can save them. This again is very interesting, because if you remember, Warren Buffett just moved a bunch of money to Japan, investing in the 5 largest houses over there. Now, on that note, thinking of Bitcoin, when you think of it at 110,000, plunged to under 80,000 within the last week, nearly a $30,000 in decline in the crypto market. Clear sign to both retailers and institutional investors. And of course, thinking of the government getting in the crypto market. Wouldn't you want to buy every single Bitcoin at a $30,000 discount? Kind of crazy to think who is going in and what institutional investors are going to take massive advantage of the drop within the cryptocurrency. Now, of course, getting out of risky assets can be tricky depending on really the timing. And if you're looking to sell, if you're looking to take those profits, risk appetite has to align. And it seems that's only half of the equation. The other half comes from really balancing a flight of safety and knowing where your assets are. So it's almost like for some people playing somewhat of a shell game. We see a lot of people that are moving money from the stock market itself into a lot of the longer term treasury bonds and so on. And really, again, just kind of moving money when you start looking at ETFs like the LT, which is the iShares 20-year treasury bond, run rate of about 5% over the last month alone. So it's been doing incredibly well on the bond side. And again, when you think of almost a rocking ship, we see a lot of money go into stocks. We see a lot of money go into bonds, CDs, a lot of safe money. And we see this back and forth motion. Now, of course, the one indicator that still stands and could be the savior when it comes to this S&P 500 over the last quarter per action, another indicator of the economic and market segment still stands for the potential turnaround of that S&P 500, which is looking at growth stocks versus value stocks. When you think of this, Warren Buffett has always said, sticking a lot more in the value of the companies, but we cannot discount the growth stocks. We cannot discount, the power that we've seen and could have been a little bit over when it comes to semiconductor ETFs, when it comes to building out all of these large artificial intelligence companies. We, in my opinion, are really just bridging the gap when it comes to artificial intelligence, having a lot more. Even when you look at two kind of shares and looking at the iShare S&P 500 on the growth side and the value side, the growth side is still outperformed the value side, which again is pretty interesting, by just over 5% in the past quarter, which means the volatility hiccup could be a correction. Now, of course, once we see that 10%, once we get to that correction category, we're going to have to see exactly what it looks like if we see tomorrow in another decline, because I believe when it comes to the NASDAQ, it was about 9.2, 9.5%, of course, went up and down throughout the day. And overall, the reason is growth stocks like the tech stock usually outperform value stocks. And even looking at the past decade, have done incredibly well. Now, we know even during this time, looking at growth, big growth companies like NVIDIA, it seems like a lot of people took money out of, but we could see a big turnaround from this stock. This is why February, when we look at the 28th, the very last day, finished the last day rallying over 1.5%. So we did see a little bit of a rally. And then, of course, the news came out when we started looking and when we started getting the news of all of the tariffs that the president was putting in place. That really drove the market down with the anticipation that these tariffs were going to stay. And like I said, it seems like a lot of these are not going to be staying as long as we thought. Now, whether it's 1 million in those option traders really are indicators at all. Only time will tell. There's no way to see the future. But when they still look at a very important factor of where people are putting their money, when we start looking and thinking of GameStop, thinking of, Kmart, Toys R Us, all of these companies that had all of those shorts against them, then of course, a lot of people took longs. I'm really upset with the whole GameStop saga. But overall, when it comes to these option traders and how they are looking at the market and what indicators they are seeing to go ahead and invest, not many times through history have they been really wrong to lose hundreds of millions, if not billions of dollars overnight with this option trading. So we could see an adjustment in the market. Want to stay tuned to see exactly what it is. But let me know in the comments what you guys think. And as always, thank you guys for watching.